All right, let's talk today about stock and bond investing and index funds. It is not a surprise to people in my audience that I think, for the most part, people's assets should not be in individual stocks, but you should have an asset allocation that makes sense for your age, financial situation, and risk tolerance. You establish that asset allocation, and then you find the lowest cost possible index fund that will give you the allocation you want with the broadest possible exposure to as much of a market as possible. Now, what is a market? To me, a market is a country or the world. Those are the markets I'm thinking of. I'm not thinking semiconductor. I'm not thinking tech. I'm not thinking even necessarily US. I'm thinking the world over the long term, but we'll get to that. So for people who remember my asset allocation video, you'll remember that I went over my asset allocation and we looked at all of these different components to asset allocation. So, I had a little percentage in crypto, and then over here, there was cash and there was real estate and different things. The biggest part of that, about 50 something percent, was stocks and bonds and both domestic and international stocks. This part, this red area, is what we're focusing in on today. So for me right now, my asset allocation is 82% in stocks and 18% in bonds. Now, of the stocks, about 10% of this is in individual stocks. Okay. The rest of it is in index funds. And of that 72 percentage points that are left, so let's even break it down more clearly. So I have 18% bonds, 10% individual stocks. And these numbers differ a little from the segment from a couple of weeks ago because this does sort of fluctuate over time. That's 28%, I believe, and I'm going from memory here. Then I have another 22% in international stocks. And then that leaves 50% in US stocks. Now, why do I prefer mostly index funds? Two reasons. Number one, I don't think humans are generally good at making predictions about individual stocks. So I think I'm going to do much better over the long run by having most of my money in index funds. Number two, it takes a lot of time to trade individual stocks, and I don't have the time to do that. So my individual stock holdings are basically companies that I'm interested in for some particular reason. I've talked about how I became a Tesla investor in 2015. Anecdotally, I've talked about that. But the majority of the money I want in index funds, which will just track how a country does. And depending on how you measure it and whether it's accounting for inflation or not, you will find that in the stock market overall, over the long term, can return about 7%. Now, sometimes you see a higher number, sometimes you see a lower number. It depends on a number of different things. So the most hands-off way to do this is what's called a target date fund. You figure out how old you're going to be when you want to retire. You figure out what year that would be. And these funds are often called something like, Target 2050 Fund. And what they do is that over time, so if we put stocks and bonds, as you get closer to retirement, they will decrease the amount of stocks and increase the amount of bonds. This is like a traditional wisdom about early, when you can have more volatility based on your age and the fact that you're still working, you have more stocks because you get a better return. Over time, you move away from stocks and towards bonds. The bonds are going to have less volatility. That's sort of the traditional wisdom. A target date fund will make this adjustment automatically. I prefer to do this individually. So as I told you, right now I'm 82% in stocks. As I get closer to retirement, I might go down on that number and go up in terms of bonds. Now, which index funds make sense? For me, I want the broadest holding altogether. So if we kind of go from narrow to wide, if we kind of think about this, kind of like a path that widens, at the top, you would have those individual stocks that we talked about. That's too narrow for me. So next, you might have an industry or industry, as the former president liked to say, an industry fund. And then if you go beyond that, you might have like an S&P 500 fund. And if you go wider than that, this is where you get to the ones that are interesting to me. So like a total US fund. Everybody has these. Fidelity, Betterment, Vanguard, etc. And then even wider than these, you have like, something called like a global stock fund or whatever the case may be. Similarly, the same thing applies with bonds. So you can hold individual bonds, and we'll put these on the left side. You can have a bond industry. You could have some kind of bond index. And then at some point you get to like a total bond fund of some kind. I'm really mostly in these things, okay? So again, my allocation is the 50% in stocks, that's in a US total fund. For international stocks, it's in a global fund. It's all countries. You could, I guess it's important to say, between US and global, you could have like a regional. It could be like Europe, all of Europe, or all of Asia, or something like that. I don't even bother. I just want to have the widest exposure to the largest number of companies over time. With the bonds, I'm in a total bond fund. And then again, with my individual stocks, I've got like Tesla and some Amazon and, Live Nation. I've got about 10 or 12 different stocks. There will be questions about mutual fund, index fund versus ETF. In terms of the tax considerations, talk to an accountant. My preference is for the lowest possible fee funds. And let's see if I might even just see if I can let's just start over. One of the things that is most important, if we think about what are the things that are going to determine your success, one, it's allocation. Are you properly allocated based on your risk? Number two is time. The longer you are in the market, the better you are going to do on average, because you're going to collect dividends for a longer period of time, and you're going to be exposed to the most number of good trading days in the markets. And number three, it's fees, and you want low fees. The exact numbers don't really matter, okay? But the concept really is what matters. So if we have time along the bottom and we have assets here as we go up, starting at time zero. Imagine two different funds. One which has I don't know, let's call it just want to make sure I'm doing this all correctly. Okay, so we're going to have our green one, which has a fee of 0.05% per year. That's a nice fee. That's a totally reasonable fee. I'm in funds that are 4 basis points. This is 5 basis points. You could see, okay, well, over time, as you add money to this fund, you're going to see the asset values go up. Part of this is returns, and part of this is that you're contributing. So, usually we show contributions along the bottom. So initially you might make really little contributions, and then over time, as your income goes up, you make bigger and bigger contributions. Okay, and then you get some return. And then on the other hand, you've got the exact same stock. Okay, same index fund, call it like an S&P 500 index fund. But this one has, call it a 0.5% a year fee. So what is going to happen over time is that with the exact same returns, you are going to see a bigger and bigger gap in your assets because of the higher fee that you are paying. Hopefully that's sort of clear. And so this is same stocks. Let's say these are both, we'll call it, these are S&P 500 funds, but with different fees. This gap right here is going to widen and widen over time. Why does it widen? Because of compounding, okay? Early on, the fact that you're paying more for the red fund than the green fund creates a very small difference. However, over time, the fact that you're getting more and more of your returns eaten away by the 50 basis point fee, it's going to leave you less capital on which to make money. And this is why you are going to fall shorter and shorter over time until eventually this gap from what might just seem like a small difference, right? I mean, this doesn't seem like a huge difference in fees over 15, 20, 25, 30 years. That's going to make a really, really big difference. This is the most important thing to consider. One other item here, and I'll make this number 4, is tax advantaged accounts. Okay. So for me, I have the same asset allocation in my taxable and tax deferred accounts. And there's reasons for that we can talk about over time. But in particular, if you are not necessarily maxing out certain contributions, you want to make sure you are contributing in the most tax advantaged way, bearing in mind that a lot of that money is getting tied up where if you need it sooner than retirement, there may be penalties. You may have to pay taxes and a penalty. So that's something to keep in mind. But so these are the 4 things that I look at. So for allocation, I want as wide as possible. For time, I kind of want forever. I mean, I don't sell. I've never sold any of my index funds. For fees, you want to be paying, if you can get 10 basis points or lower, that's great. And tax advantage accounts, this is more of a conversation for a different segment. All right, so index funds, really easy. One of the biggest tricks that the financial services industry has successfully pulled on people is making people think that this stuff has to be a lot more complicated than it is. It really doesn't. I will just do this once more just to be crystal clear. You can have a 3-fund portfolio, okay? Look at this tiny box that it fits in. You can say, I don't know, let's make the numbers just a little easier. So you could say, I am going to do 55% total US stock. Every financial services company has one of these. And then you can say 25% total global stock. And then that leaves 20% total bond. That's it. And you can get all of this, if you look in the right places, for 5 basis points, 0.05% in fees. It really is this simple. There's no trick. There's no trick. Tax loss harvesting would be the one other thing to talk about. Not even going to mention it today.